Hi, everybody. I'm Dale Branda with Stewart Advisors. Welcome to our ongoing webinar series on topics of interest to our clients and friends of the firm. Today, we're going to be discussing retirement planning and specifically the issue of retiring during uncertain times. To help me present, I'm joined by a couple of my colleagues, Tim Obendorf and Mike Kwan. Now, both of these guys have been working with families and individuals for 20 plus years, and they've had a lot of different conversations about retirement planning in a lot of different economic scenarios. So they are pretty good resources for our discussion today. And we're going to trade off presenting responsibilities as we move through the presentation. As a financial planning and investment firm, it's our mission to help people make good financial decisions that realize their goals. As you can see from the slide, we provide a lot of different services, but the idea is that we want to help clients develop a consistent, holistic financial plan that holds up whatever may come in the future. So as Tim and Mike and I work with clients, we get a lot of different questions about retirement and retirement planning, and we find that most of them boil down to kind of a single underlying issue, which is, am I going to run out of money? Now, sometimes it gets spun a little differently. How much do I need to retire, or something similar? And it seems like a pretty straightforward question, but of course the answer is highly variable depending on your situation. So what we're going to try to do today is look at some key questions that you should be asking yourself and try to give you a methodology for answering the question for yourself and your family. We're going to stay focused on the question that brought us here. So we're going to spend most of our time looking at how you can identify and calculate and even stress test the amount that you need to retire successfully. After that, we're going to talk a little bit about the importance of a written plan. And finally, we'll discuss some ways that you can improve your chances of success or even get your plan back on track if it's broken. Now, as I said, we're going to try and end at 30 minutes or before, and we will then stay around for any questions that you may have. And as I said, feel free to submit them using the Q&A button on your console. So with that, I'm going to kick things over to Mike and we'll get started.
Thanks, Dale. Let's take a look at the four biggest concerns people have when approaching retirement. The number one concern is running out of money. During our working years, we've accumulated assets, but making account withdrawals during retirement is very different. You'll need to decide which accounts to take money from and how much to withdraw, and learn why some strategies work better in stretching your money to last longer. So let's take a look at a couple of ideas. Let's assume you're now retired. You have no idea how long you're going to live, and it could be for a very long time. One investment strategy can help you add up to 2 to 5 years of additional income during your lifetime, and it's called a guardrail strategy. First, we assume you have a diversified portfolio of growth and income assets, and this is based on a philosophy that it makes more sense to not withdraw from stocks when their values are low in a down market. Instead, take your money from lower earning assets like bond investments. And the reason for this is this allows the growth assets time to rebound, as they are typically higher performing over the long run. A second asset to consider is a part-time job earning income in retirement in something that you love to do. This ideally would be a job that would keep you engaged, provide you meaning, and a sense of accomplishment. We just had some renewal landscape work done at our house and learned that our landscape architect and project manager, Kathy, is doing exactly this. She retired early and is doing what she loves over the past 18 years. Her passion for gardening put her on the path, and her plant nursery helped her learn the ropes. Working and making a supplemental income, particularly in years where your portfolio value is down, and taking smaller investment withdrawals can really help to stretch your money to last longer. The second biggest concern is losing your job as you get closer to retirement. Many people in their 50s seem to be targets for job cuts. It seems like a third of my friends have lost jobs in their 50s and 60s. So we'll suggest a couple of income bridges to consider on the next slide. Third, economic changes are going to occur. Our experience in 2020 tells us an unprecedented health crisis can change things in a hurry and also create a financial crisis. The question many ponder is, what should I be doing differently with my money and my investments? And there's healthcare. Let's look at some of the comprehensive health insurance. In the US, our access to healthcare insurance is tied to employment. I think we all know this, we just don't process it. If you have a government job or work for a larger corporation, you likely have access to good, affordable health insurance. However, many people in pre-retirement are facing health insurance issues before age 65 because of lost jobs or changing employers. And age 65 for Medicare is the finish line for affordable health coverage for everyone in the US. Individual and small group comprehensive plans can be very expensive for people between age 55 and 65. I call this the Medicare insurance gap group. Personally, my wife and I spend almost $1,800 a month for the two of us for our small group health insurance. Somehow spending more on health premiums than you might for a mortgage, property taxes, and utilities combined doesn't seem quite right. And it's just insurance protection if we really get sick. Let's look at two other options. If you're over age 55, you may want to consider getting a part-time job at a big box store or large employer, say Starbucks, Target, Home Depot, to access more affordable health insurance as an employee benefit. And the marketplace, also known as a good option if you have a pre-existing condition or taxable income under $69,000 for a couple. The reason why is the government subsidies can lower premiums by up to $1,000 a month. So for people ages 55 to 65 making $70,000 or more in taxable income, Obamacare is still very expensive, but for those people below that level, you can get subsidies. We've seen clients that have significant assets get large government subsidies for health insurance through the marketplace. And that's because the subsidies are based on annual taxable income and not assets. So when we look at 2020, we find ourselves dealing with all four of these major pre-retirement issues converging all at the same time. Our COVID-19 pandemic is a global health crisis. And by staying at home to flatten the curve, it created massive unemployment. I just heard that over 2 million restaurants globally are likely to close, and that up to 44 million people in the US have needed to replace income. Let's go to the next slide. Next in a financial crisis, and what if I've lost my job or think it could happen to me? First, if you lose your job, you should immediately file for unemployment insurance. That's a given if you need money now. And let's talk about two resources to temporarily provide you a way to build an income bridge to your next job and income. If you own your home, consider establishing a home equity line of credit as a backup reserve to your emergency fund. And do this while you have predictable income, because loans are based on your repayment ability. Interest rates are low, and you can structure the line of credit to pay back interest only for lower payments until you're back on your feet financially. Without earned income, you'll likely be in a lower tax situation, so overall tax rates and payments should be less than normal. And taking money out of one of your retirement investment accounts can also be an option. The CARES Act passed earlier this year allows for what I would call a coronavirus emergency access to 401k accounts up to $100,000 without the normal 10% early withdrawal penalty. And you can spread the income tax payments over the next 3 years, 2020, 21, and 22. And also the 60-day rule for being able to move money out of an account, perhaps taking a 60-day loan and then replenishing that money back into your tax-deferred retirement account has been increased to 3 years here. So you have 3 years from the time that if you were to take up to $100,000, put the money back in and not have a tax consideration. So this is a worthwhile temporary income replacement vehicle. And what should you do with your investments? Here's a few ideas. The US and global financial markets have been on a wild ride in 2020. The stock market went into a bear market and was down over 30% in 4 weeks' time during late February and March. That's really never happened before so quickly. And we've learned up to 80% of investors are taking more risk with their investments than they're personally comfortable. So first, we'd say review and reassess your risk profile and determine if your willingness to accept higher risk has changed. If you've been too aggressive and realize you're actually more conservative, you should reduce the level of risk assets you hold. And everyone should rebalance their investments at least annually in check. Not rebalancing is why many find themselves in a position where they can make more money, but also have larger losses. During the past two US bear markets, the 2001 to 2002 dot-com crisis and the 07-08 financial crisis, where the stock market was down more than 20%, there were actually multiple declines during that time frame. It was a roller coaster ride, ultimately resulting in smaller account values. And that might be where we are today, waiting for the other shoe to drop. The U.S. always recovered from bear market losses, but you can do something other than stay in the course or go into cash to provide additional protection for your nest egg, additional downside protection. We found one hedging strategy where the specialty investment can protect your capital, provide you liquidity, give you upside potential, and do so where the costs are of value and the investment is easy to understand. We implemented this fund strategy with many clients a few months ago. Currently, our income tax rates are low by historic standards. Converting tax-deferred assets to tax-free vehicles to save tax dollars is worth considering. Tax rates could be higher in 2022 and beyond to raise tax revenue and pay for the trillions of dollars in COVID-19 economic stimulus. For our clients, we have a tax planning tool called Holistiplan, and it's designed to do tax what-ifs to analyze tax saving ideas using a recent tax return. During the coronavirus, people seem to be more reflective. At least that's what I have seen. Consider if you could use better financial expertise to get the retirement you want and deserve. And the last topic on this slide is, will I outlive my money? Life is always changing. We believe using planning tools to help us address the what ifs in life are helpful in providing peace of mind and show us if I'll still be okay. A good fiduciary advisor will show people where they stand and see more clearly how to make better choices. Tim will cover the merits of advanced planning during his presentation. Let's switch gears a bit and get you thinking about how you want to live life in the future. It begins with starting with a vision. The first step in thinking about retirement is to create a vision for what you would like to do in retirement. This is the time in your life where you'll have true freedom. And what does that vision look like to you? Let's do what could be a game changer for you in how you live. So let's say you go see your doctor, and your doctor says you're healthy and you'll continue to be healthy, but you only have 5 to 10 years left to live. How would that impact your thinking, and what choices would you make? What would you change and do differently? What would you want to do and accomplish within your family and close relationships? And how would you live? Do you have unfinished business that's important to you? And what values would you want to pass on to future generations? And how do you give back if that's meaningful to you? If you're married, we recommend you spend time with your spouse talking about your retirement vision and how you'll make it work together. And finally, think carefully about all your options, because once your vision comes into focus, it's really time to drill into details about your retirement. Where you will retire may change many things. If you move out of state, you'll make new friends, identify new service providers. Healthcare access should be on your criteria list. And would you want to take care of a regular house or have a condo that you could shut the door and worry no more when you're traveling? When will you retire? Will your spouse retire at a different time? These are separate decisions from what you will claim with Social Security. And what activities would you pursue? There's really a lot to think about and discuss. And these soft planning issues are all important because it reflects how you choose to live life. I'll pass the baton to Tim, and he'll cover how to organize your financial resources. Tim?
Thanks, Mike. So the next step in planning, Dale, actually, if you want to run to the next slide there. The next step is to assess all your resources and your obligations. And we work with our clients to get a picture of all their assets and liabilities and have a system to update those as they change. This inventory should include your retirement assets, your non-retirement investments, business interests, real estate, cash value of life insurance, mortgages, credit card balances, and other loans, just to name the most common items. The net of what you own and what you owe is your net worth. And that's what you'll use to fund your retirement. Not only should you inventory your current assets and liabilities, it's important to project into the future to determine future sources of income and expenses. Future income could include an annuity or pension, inheritance, Social Security, part-time or full-time work, proceeds from the sale of assets like a business or real estate. And to estimate future expenses, start with your base living expenses as they are today. And according to a recent study by David Blanchett at Morningstar, your retirement expenses could range anywhere from 54 to 87% of pre-retirement income. And on top of that, future expenses could include funding your kids' college, maybe a wedding, buying a second home, some exotic travel, medical expenses or moving expenses. And in that same study, Blanchett found that expenses in retirement don't necessarily grow at the rate of inflation. In fact, what he found is that in the early years, the expenses tend to go down, and then they increase faster than inflation in later years as medical expenses increase. And that is slightly different depending on your income level, kind of how that curve works out in retirement. So once you've identified your current resources and obligations and future income and expenses, you have what you need to build a cash flow projection. And the cash flow projection is also going to require a number of assumptions. So things like what's the inflation rate or investment returns. And while we know many of the assumptions won't turn out as expected, the cash flow projection will give you a baseline to evaluate some of the choices you make in retirement. So if we go to the next slide, we'll show you a picture here. On the right-hand side is an example of a net worth statement that we work with clients to prepare. So this has your assets and liabilities, and it's a snapshot in time. And then the left-hand side is a graph of the cash flow projection. And the cash flow projection may go out 30 or 50 years even out into the future. Let's go to the next slide. And so we know anytime we're projecting way out into the future, especially for time periods as long as 50 years, things are going to turn out differently than expected. Inflation might be higher or lower. Investment returns are going to vary every year, and your life expectancy probably is not going to be exactly average life expectancy. And so to take those variables into account, we use statistical tools to run 1,000 or more scenarios where the inflation rate, investment returns, and life expectancy are different in every scenario. And with the recent economic distress, we've been getting a lot of questions about how to think about inflation and investment returns going forward. There's growing concern that government debt could lead to higher inflation. However, in the short term, we don't expect significant inflation just due to the fact that there's so much slack in the economy. Going forward, though, that may be an issue that we want to model, and that's one of the reasons that we run the large number of scenarios, is to determine how would your financial plan work if there were higher inflation or lower investment returns. Now, the graph here on the right gives you a picture of how an investment portfolio might grow under various scenarios. So in this case, the investor starts with about $1 million, and over 20 years, in some scenarios, that investment grows to about $2 million. And in some scenarios, it grows to as much as $11 million. So a big range of outcomes in the future. One of the values of running the 1,000 scenarios is that it gives us an ability to estimate the chance or probability that you'll have enough money to last through retirement. And our goal is to get clients to a point where in 90% of these scenarios that they have enough money to last through retirement. And while we would have never been able to anticipate COVID-19 and the economic impact, many of the scenarios that we run mirror the economic impact and market sell-off that we've seen in the past few months. So the takeaway here is that we know that there's going to be financial storms that impact financial plans, and we're trying to build financial plans that can weather those storms. So before we go on with the planning process, I want to just have a little conversation about Social Security. And it's one of the major sources of income in retirement. Yeah, most of us don't have a good understanding of how it fits into our overall financial plans. So not only do you get your direct Social Security benefit if you've worked 40 quarters, but if you were married for 10 or more years, you may also be eligible for a spousal benefit, even if you're divorced or widowed. Your benefits based on your earnings history and also on the age that you claim your benefit. And to estimate your benefit, you can go onto the Social Security Administration's website, set up an account, and you can see your exact projected benefit. The timing of collecting and your benefit and your spousal benefit are two separate decisions. And you can imagine there's multiple options for husband and wife to claim their benefits. If you claim before your full retirement age, your benefit could be reduced if you have other income. And so when evaluating the various claiming options, you need to consider tax implications. You'll have to look at alternative funding sources if you delay your Social Security benefit. And you'll also have to look at your health and life expectancy. Finally, one question we're often asked is whether you can really count on your Social Security benefit. And the most recent trustee report estimated that the Social Security Trust Fund will be depleted in 2035. But because of the economic impact of COVID and higher unemployment right now, it's possible that because there's lower funding going into Social Security, that it could run out, could be depleted as early as 2032. And at that point, the Social Security will be receiving income from payroll taxes that'll cover about a little bit more than 75% of benefits, assuming no changes in the program. At this point, we're not discounting the Social Security benefits when we're doing the long-term cash flow projections, but there is some risk to the program that you should be aware of. And there's a lot more about Social Security that we could cover. In fact, it's such an important topic that we plan to do another webinar just solely focused on Social Security. So let's go back to the planning process. And it may seem like a lot of work, but planning allows you to do a dry run on your retirement before you're actually retired. And it organizes your thoughts about retirement, provides a baseline to evaluate future decisions. And then when you're reviewing and revising the plan over time, it's going to help you keep on track. And you'll also be confident knowing on how you're going to replace your paycheck in retirement. Below here, we have some of the key dates that you need to consider. And one of the dates I want to focus in on is on the bottom right-hand side there, the age 72 beginning date for required distributions from qualified accounts. And for years and years, if you had a qualified account, you were required to start taking distributions in the year that you turned age 70 and a half. But in 2019, there was a piece of legislation called the Secure Act that pushed that back to age 72. But now in 2020, because of the CARES Act, we've been given a reprieve. So there's no required minimum distribution in 2020. And there may be some planning opportunities if you don't have to take, if you were previously scheduled to take a minimum distribution and you no longer have to do that. Things like doing a Roth conversion may be a great opportunity in this year. So as I mentioned, doing a plan is like doing a dry run on your retirement. And if you find out that your plan doesn't exactly work, you still have time to make different decisions to improve your success. And I want to walk through 6 key levers that you can use to improve your retirement success. The first is to save more. And one of the few benefits that have come out of, few economic benefits that have come out of the pandemic is that you're probably spending less on entertainment and travel. So you might consider using some of those savings, or maybe you got a stimulus check, use those savings to build up your retirement funds. A kind of flip side to that is that the second lever is to reduce debt. And some of the creative debt reduction strategies that we've seen are to wait longer to buy a car. You're probably driving less right now, so that's a possibility. Paying down student debt. So another provision of the CARES Act was that for federal direct student loans, all payments on student loans go directly to principal. Now, there's a lot of complicated planning caveats to that, so you should talk to an advisor before you do that, but that's an opportunity. You might also look at moving to a lower cost residence. So, many of us are finding we can work from anywhere during this pandemic. So, Chicago is a pretty high cost area. There's other places that might be cheaper. Look for additional income in retirement, and this could involve turning a hobby into a business or creating an income producing asset like rental property. Some of the creative ideas we've seen here are people that are big golf fanatics getting a job as a golf marshal, where not only are you getting income, but you might be able to get free tee times to cover what would have been an expense in retirement. Similarly, you can get temporary jobs in the national parks. So if national parks are of interest to you, you can each year go to a different national park and work there. We all know there are lots of different gig economy worker opportunities. So things like driving for Uber or food delivery. We've also found that we can work remotely. So you might be able to stay part-time in your current career, but do it from a different place. The fourth lever we'll take a look at is adjusting your lifestyle in retirement. And Mike mentioned this guardrail strategy. So one of the things that we find is difficult to do is to actually go backwards and spend less in retirement. But if there's a year where your investments don't perform, your willingness to dial back on some expenses, some things like travel that you might not necessarily need to do every year, just dialing back in those off years could significantly improve your retirement success. A fifth lever is to take a look at changing your retirements, and changing your investment assets. So it's not always the most risky or the most conservative portfolio that's successful in funding your retirement. And as Mike mentioned, there are some hedging strategies that could help buffer market volatility and possibly increase your retirement success. You'll want to run scenarios with different investment options to see which investments actually help you have the most successful retirement financially. The last lever I'm going to mention here is retiring later. And there was a recent study that was done by Stanford University and the National Bureau of Economic Research, and it showed that working just 3 to 6 months longer before retiring had the same impact on your retirement standard of living as saving an additional 1% of your earnings over 30 years. So that's a pretty significant leverage for just delaying retirement a little bit. Now, finally, we'd like to show you a few resources that you can access on your own. Dale, if you want to go to the next slide. These are just some websites that we've identified that have great information that you can use. We mentioned the Social Security Administration. Living to 100 is a site where you can answer some questions and it gives you a sense of what your health and longevity should be. The IRS obviously has a lot of tax information, but they also have information on retirement plans. AARP has a wealth of information, and everything from Medicare plans to articles on aging and finance. The Financial Planning Association actually has a public section of their website with a number of white papers that are right up the alley of retirement planning. And then we have a couple of resources on our website. So there's a one-page listing of 11 questions that you should be asking yourself to plan for a secure retirement. And we also have a case study that's a pre-retiree couple looking at, do they have the ability to actually retire and maintain their standard of living. So we know the recent economic turmoil has put a lot of stress on many people's financial situations. And if there's one thing that we want you to take away from today's webinar, it's that by doing some advanced planning, you can identify potential shortfalls in your plan while you still have time to fix those shortfalls. So I know we had some questions ahead of time, but we've probably also raised some questions. So I'm going to turn it back to Dale, and we'll go into a little Q&A time.
Thanks. We did have a couple questions that were submitted. I'm going to try and combine a couple that are similar. So one question that has been asked, somebody wanted to know about the options for lowering tax liabilities through out-of-state residency benefits. So I assume the route is, should I move if I'm in a high tax, high cost state?
Yeah, so obviously tax planning is an important part of building a retirement plan. And Mike had mentioned that we have some planning software where we can model various tax strategies. And especially as you approach retirement, there may be years where you have higher or lower income that you can take advantage of some strategies. And then your state of location is obviously a big factor. So, there's a number of states like Florida where they don't have an income tax. That can have a big impact on your retirement success. Now, one of the positive things in Illinois is that retirement income isn't taxed in Illinois. There are some states that do tax retirement income. So withdrawals from qualified plans or Social Security income, it's not the majority of states, but there are some states that do tax that. So just be aware of that. And then there's also estate tax issues that are different by state. So, with 50 states out there with different tax regimes, it's impossible to talk about specific state location strategies, but it's definitely something that you want to look at in your retirement planning.
Okay, another question that someone asked is whether a variable annuity fits into a retirement plan.
Yeah, so, one of the challenges with talking about annuities is that there's so many different flavors of annuities. And the variable annuity, just think of it as it's a wrapper around an investment that can have various market performance like stocks or like bonds. And so there may be some tax advantages of wrapping your investment inside of an annuity. But the actual success or the biggest driver will be the cost of the annuity and the type of underlying investment. So again, this is something we'd be happy to go into in more detail on a specific basis, but it's something you should be looking at all the options available to you as you do your planning.
Yeah, I should say there has been some movement in the annuity market. We're seeing the development of some fee-free annuities so that that you get through an advisor versus through a broker dealer. So at least one layer of some of the costs involved are potentially less. So it's something to consider looking at if that's the direction that your plan is moving. The last, I guess, group of questions relate back to the whole topic of Social Security. And, with the caveat, we are going to try and delve into that more deeply in another session. And also that this is a really individual thing. So for some of this, really, we'd have to talk to you offline. But I think we can kind of address the high level issues. A couple questions we're asking about the recommended age to start collecting Social Security, and also, whether a part-time job or if there are income opportunities that don't negatively impact on that. And then, also, what about the spouse? Does it make sense to have the spouse start collecting when the primary insured is deferring? I realize there's a lot there, so let me know if you want me to repeat anything.
And that's one of the reasons that we want to do a webinar specifically on Social Security. Just because there are so many variables, and when you talk about a husband and wife making those claiming decisions, it really becomes complicated, and you need to run some scenario planning around that to see what makes the most sense. Dale, I think we have in the appendix here, we have a schedule that shows some Social Security payouts.
Yeah, we actually pulled this slide out of the presentation. We didn't think we'd
Okay,
use it.
yeah, so one of the things most people know is that if you delay when you claim your Social Security, it increases your benefit, your monthly benefit. So the average monthly benefit for Social Security, if you claim at your full retirement age, is $1,500. And so most people right now, their full retirement age is 66 and a fraction, some months, or age 67. So that's what we have highlighted here. That's where you would get 100% of your primary benefit. And if you delay beyond that, it goes up by 8% a year. And if you take it before that, it's discounted. And so there's lots of combinations, and one of the things you have to look at is what's your life expectancy, what do you give up, every year you delay is a year that you're not getting those Social Security benefits, and what does that look like over your lifetime? So it's a complex piece of retirement planning, and we plan to do a whole webinar session on that. I think one other piece of the question was about income and how it impacts Social Security. So if you claim your benefit before your full retirement age and have outside income, that may reduce your benefit. And then if your total income is over a certain dollar amount, some portion of your Social Security may be taxed up to 85% of it. So those are factors that you have to take into account. I would say that you will always be better off having more income. And so even though it may reduce your benefit, in total, you'll have more cash flow by having some other income.
All right, well, I think that's it. We are a couple minutes past our time, and we appreciate everyone sticking with us. If you have follow-on questions or anything like that, feel free to contact any of us. Our addresses are on the website, stewardadvisors.com. And as I said, we'll have this session or the next session posted on our site within a few days, so you can pass that on or take another look. Again, thanks so much, and have a great day.